we'll get to the Fed in a moment, but the unanchoring narrative that Summers projects, you would perhaps take the other side of that trade. You talk about core CPI, and you say core CPI is improving. You're not in the unanchored zone, are you?
No, we think it's improving. We saw the data help prove our view that, we saw that inflation dropped from 4.3 to 4% this month. We think that inflation is going to start reversing maybe in the first half of next year. It looks like also that the Fed is concentrating a lot on the employment data as well, which came off a little bit weak, so they're going to need to see a little bit more stronger data before they start tapering. So we're still on the camp of transitory inflation, and it's looking like our view is working out.
I mean, stagflation as a word has gained enormous momentum in terms of readership and authorship as well, because the term is being used at the highest level since about 2011 in terms of the span that Bloomberg data covers on this particular metric. GT, go for our clients to show you where else we're seeing quite a bit of movement. Consumer sentiment has been down on rising prices. The two lines moving completely opposite directions. And that may mean that the Fed has to normalize policy sooner rather than later. What do you make of that?
So we're going to see the Fed meeting this coming week. Now, I don't think there's going to be any major changes from the Fed this week, but it's still going to be an important one. First, we're going to see that the Fed is going to be a little bit more upfront about that they're going to taper. We still expect them to announce tapering in November and start tapering in December at $15 billion every meeting. So the liquidity is going to be in the market for probably at least the first half of next year. The second point that's important is we're going to see the dot plot for 2024 for the first time. And as of now, the dot plots, so the expectations are there's not going to be a rate hike in 2022. But if you see that there's 7 out of the 18 members are seeing a rate hike, so it's going to take 2 more to shift the median to show a rate hike in 2022. 2023, 2024, the market expects 3 to 4 rate hikes every year, which is on pace of 2017, 2018. A slow pace, still accommodative for the market. So we're going to see a slow approach from the Fed. We don't see there's going to be a taper tantrum as before that we saw in 2013. It's going to be very well communicated, and the Fed has managed to do that very well.
And that's certainly represented in the DEC dollar spread. We saw huge activity in the 2024 contract, Kareem, which suggests the market is moving just that little bit further out. We started by reflecting on equities, and I used the phrase it's going to be a monster week. A monster week in terms of flow. I'll give you the numbers again. 62 billion came out of cash, and 51 billion went into equities. Yet I look at Morgan Stanley, and they're going overweight cash. Are you taking any protective measures? Were you irked by any of the risk-off narrative at the end of last week?
We're still moderately overweight through our overweight U.S. Position. We still think that it's an accommodative market, and as we said, the slow, the slow tapering will be helpful for the markets. And we saw from the ECB as well that they're going to take their time to actually exit their policy. So that's all positive for the markets. Again, we're seeing also the Delta variant starting to peak in many places. That's also positive. And earnings season wasn't too bad last quarter as well. So there's a lot of positives for the market. We are, seeing a little bit of a higher risk of a correction in the shorter term because the market has run up and valuations are not cheap. But fundamentals overall, economic fundamentals are still okay. We have to also keep in mind that we are approaching growth, peak growth. So growth rate has peaked, in our opinion, but growth is still going to be healthy going forward.
Kareem, there's a cascade of charts on the Bloomberg terminal that really tell the pain that a lot of investors exposed to either Evergrande bonds or stocks have been suffering from, and that is something that we're keeping a very close eye on. In terms of the broader argument around the fact that much of the debt that is owed is held by foreign investors. To what extent does that perhaps prevent more systemic damage to financial stability in China and this thing spinning out of control?
I mean, China is keeping a close eye on the situation right now. As you could see, that they're kind of trying to tread this thin line between moral hazard of another bailout or helping it out in less than market-based conditions, and having it go into the economy and have a systemic risk. At the moment, our base case scenario is that it's not going to present a systemic risk. We think that the risk is going to be limited. However, a lot of the developers, especially the ones that are highly leveraged, other than Evergrande, are suffering with lower margins, as we saw in the last earnings seasons. So we prefer to direct our investors, and especially those that hold US dollar bonds in real estate, from the B rating to maybe a double B, and move a little bit higher up the quality of bonds, because there are still some opportunities there that are presented. We still, and for those that have concentrated Chinese positions, we recommend that they go into maybe CEMEA, which we are overweight on in terms of bonds in both high yield and investment grade. Not necessarily overweight, just we prefer. I think reducing exposure is important. There is going to be some pain, definitely, that's going to be felt because of the possibility of default.
So we've just showed a whole cascade of charts, but I want to focus in on the high yield space, Karim, because that's where contagion and bleeding can certainly have a tough effect both on credit and on the equity market. Now, the high yield space in China is up at 14%. You're looking at a decade high. Have any of your investors become worried or wary of perhaps some of the bond exposure that they have? Does 14% not ring a huge alarm bell? I know you say no systemic risk, but it certainly rang a lot of bells at lunch and dinner over the weekend for me and a number of people.
I know investors are definitely worried, and however, for a lot of our investors, they have been very well diversified, not just into China in terms of the high yield space, but over EM, because we are still overweight EM high yield. However, as I said, those that have heavy positions in China, we have been advocating that they should shift some of these positions. We went from, including Chinese equities, by the way, we went from overweight in Chinese equities to neutral recently, because there's a very tight balance as well between the regulatory environment that we're seeing Chinese equities, the same that we saw on the real estate in 2020, where there was the 3 red lines. So there's a regulatory environment in China that's not very supportive, but valuations are supportive. And again, if we move to the double B quality, there are some attractive opportunities if you look bottom up, but you have to know the companies that you're getting into. They shouldn't be highly leveraged, because the margins are getting squeezed, and smaller companies might be eventually bought out by bigger companies that are expecting higher growth, because, especially if they're highly leveraged.